Hey guys, it's Dale with the Insurance with your quirky question of the week. This week we have a question that actually comes up quite often. A lot of you may think you know the answer to the question, but I bet there's one factor in here that you probably don't know about. That question is, what do insurance companies take into account when they come up with your insurance rate, right? What factors do they take a look at? Some of the obvious objective factors are the type of coverage that you're looking at, what amount that coverage is, the amount of your deductible, the type of car you drive, the purpose of your driving. Are you simply driving 5 miles to work, 5 miles back, or are you actually on the road for 2-3 hours a day? Where you live is also taken into account. Your driving record is also taken into account. And then there's several personal factors like age, which is kind of an indicator of driving experience, how long you've been driving, your marital status, your sex. And then there's this subjective factor, which is essentially a credit-based insurance score, which is a compilation of obviously your credit and things of that nature, but is almost proprietary to these insurance companies where they score you, and based on whether it be your credit, how often you pay down your debt. They provide a score that influences that rate. The funny thing about this is that it sounds very similar to an idea that's called, or a concept that's called, customer lifetime value, right? So it's essentially your lifetime value for that carrier. And a lot of companies use it. You may find yourself on the phone with, let's say, your cable company, and you're always wondering, why am I on hold for 30-40 minutes at a time? And it very well could be because of your customer lifetime value, which takes into account, like I said, things like, do you often buy at a deep discount? Do you often pay your bills on time? These subjective factors that are taken into account and ascribed a score to you, basically. Another example is, are you always offered kind of a loaner vehicle when you go to your local dealership, but your colleague may not be offered that same vehicle? Your customer lifetime value in comparison to that colleague could be higher. So those are a few things that insurance companies and actual companies in general take into account when they market to you, and more specifically when an insurance company rates you. So for this time around, just know your value, and when you do shop, keep in mind that you bear a score relative to your peers. Once again, for the quirky question of the week, send your questions to questions@einsurer.com, and I'll talk to you next week. Bye.